Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zaegel, and this episode is brought to you by CWOsforhire.com, which is the financial planning firm that I co-own. We are bringing on some new clients this time of year. We don't do that all year long, so if you're interested in help or really just want to talk to us and ask some questions, we'd be happy to talk with you. It's a crazy time to be invested, obviously, but we're helping a lot of people navigate the market. So if you need some help or have questions, please feel free to reach out to us at CWOsforhire.com. Speaking of crazy time to be an investor, there is a tug of war going on, and there are actually probably a lot of different tugs of war going on all around the world figuratively. Let's talk a little bit about a mental tug of war that a lot of investors have right now, specifically, and especially, not specifically, but especially those who are in retirement or near retirement. And this came to mind. I'd been thinking about it a little bit, but I had a conversation with a client recently who was just a little nervous about everything going on in the market, which a lot of people are, very understandably so. And one of the questions he asked was, well, how many other clients are calling you, asking you about this? And I thought about it. I was like, yeah, we're getting some questions. This is different this time in terms of the number of different things happening all at once with the market downturn. The downturn itself in the market actually hasn't been that big yet, or possibly. We don't know where it's going to go in the future, obviously. Could go down further, could go back up. Who knows? Who knows? Nobody really knows. But what's interesting about this time is in past downturns, there's been more of an emphasis on one thing, or maybe even just one or two things. For example, in 2022, it was a really bad year for both stocks and bonds because interest rates were rising very sharply. Obviously, there were other things going on too, but that was predominantly the focus. Was now you have interest rates going up. You have an alternative to some investments. You have more difficult lending for some smaller companies, things like that, all coming off of an increase in interest rates quite sharply. And obviously back in COVID, that was a big thing that dropped the stock market down. Now that bounced back up pretty darn quickly. But again, it was just focused on one specific thing that was really driving down the market. Even back in 2018, most people don't remember the end of 2018. That was also a time when the Federal Reserve was increasing interest rates fairly rapidly. The fourth quarter of 2018 was pretty nasty until they came out on Christmas Eve and said, just kidding, we're done. And then the market shot up and had quite a nice run since then. So it's been interesting this time around where there's multiple different factors in play here, because you've got some inflation concerns, some tariff concerns, just a number of different things coming out really on a daily basis. And so this time is a little bit different. And I realized when I was asked this question about how many clients are calling, it is actually a little bit more than usual. In the past, I wouldn't get a whole lot of questions, maybe a handful, and nobody right now is really panicking, but there's definitely more questions this time, and I think it is because there's more going on. Now, to be fair, if we think about the 2020 sharp dip in recovery, there really wasn't a whole lot of time for people to ask a lot of questions. It happened actually pretty quickly, and there was a whole lot of other stuff going on at that time. So we didn't get a ton of questions from clients then. Even in 2022, which was a nasty year, didn't get a lot of questions. We're getting more now just because of the different pieces going on. So I thought this would be helpful when we talk about the tug of war between the tug of war going on in investors' minds, especially when you're in or near retirement, Because when you have events like this where there's just a lot of uncertainty, maybe it doesn't turn out to be all that bad, but there's still just a lot of ifs. It's very natural to think, I need safety, which is totally understandable. If you're in retirement, you're like, I have this chunk of money, I need it safe, I don't want to lose it, and I don't know what's going on right now. It's very understandable to want to shift into more safety. Who wouldn't? There are very few people who would go, yeah, let's take on more risk right now. Some would, and that's great, but not everybody. Most people, when they're no longer earning money or they soon won't be, they're naturally going to want to shift and say, whew, we need to go heavy into safety, forget the stock stuff, maybe just how do we position ourselves to where we don't take as much of a loss? And there's things that you can do with specific investments. There are funds out there that provide buffers. We've talked a little bit about structured notes on this podcast, things like that, that can provide some safety while still allowing you to invest. But it's important to also understand that sometimes going safer can actually introduce some more risks long term. So we have to play with this tug of war where we know that we want safety, but the other side is we know that we need the growth long term, especially if you're in your 50s, 60s, even 70s. You've got probably a few decades, hopefully, to go and where you'll need this money. So you can't just sit in cash or money markets or even bonds or CDs and hope that that works for 20, 30, 40 years. You still need that growth. Now, if you're really, really wealthy and you can just live off interest, that's great. Good for you. Most people cannot do that. For most people who are retired and they have some investments, they need that growth. So it's this pull between I want safety because crazy stuff is happening with the stock market on a day-to-day basis and I don't know what to do. Or pulling that against we need this long-term growth. And we can't harm that because that will harm us long term if we don't have that long term growth. So that's the tug of war that goes on with investors, especially when they are in retirement or getting ready to retire very soon. How do we address that? We go back to the thing that you've heard me talk about a million times, it seems, if you listen to this podcast. We always make sure that we have at least 5 years worth of income set. So whatever your next 5 years of income are, we want to make sure that those are set in individual bonds, CDs, structured notes, things with maturities at certain points in time, and things that are very safe. So that way we know no matter what the stock market does in the short to medium term, we have income for at least the next 5 years. And then the rest of it can be focused on longer term growth. Now, when we have this tug of war where we need more safety, maybe instead of 5 years, maybe we add a sixth year, possibly a seventh year, maybe an eighth year. That's a little bit long, but we can add some more years of safety if needed. Now, the better answer, which we were focused on several months ago, was let's add that safety when the market's doing really well. That is the key strategy long term, is to say we've just had a great 2023, a great 2024, which, by the way, both of those had their ups and downs. They had similar drops to what we're experiencing now. That it just wasn't as loud, and we tend not to remember them, but they had their drops as well. But those were two really, really good years. So as we were coming into 2025, in a lot of cases, we said, well, we have 5 years of income for you. What do you think about adding year 6? It's not a huge shift, but it's something. Now, instead of 5 years of income, now you got 6. Now, when the market does whatever it's going to do, we have 6 years to ride it out. And historically, that's been enough time. We can look back, even in the 2008, 2009 mess, it took about 5 years to come back. And actually, in the Great Depression, the big, scary, and awful Great Depression, it took about 5 years, actually a little bit less than 5 years for it to come back. So we've given ourselves enough time for the stock market to recover knowing that we have this set income along the way for at least the next 5 years. And that is how you can solve this tug of war and this need for safety, is to set up that safety in advance of at least 5 years and let the rest grow. And you can make minor changes to that if you see fit, as long as it's not really going to harm your retirement. You can start moving some over to safety as long as you still have enough of that piece of growth long term, which you'll need in retirement. So if you find yourself yearning for safety, make sure that you have at least 5 years set up. And next time, if you're not in that place right now, go ahead and start to set that up, and set it up so that next time we have a nice run higher in the stock market, you can make sure that you've got that 5, maybe 6, 7 years if you want to. If you want to get a little bit safer, have those years set up so when the market does go down, you can look at that and say, I've got this income. Yes, this growth piece stinks right now, but I know it's there for the long term. We can focus on this income. And that's how you can not get around, but help mitigate and solve and bring yourself some peace around this tug of war, this need and desire for safety when the market goes crazy. Set that up in advance, have it there. It actually turns into your friend, because now you know you have this income and you can focus on opportunities with those long-term funds.